Good morning all, and thank you very much indeed for those excellent talks. First of all, this morning, thank you for Resourcing Tomorrow, for having us here today, and for joining Evy Hambro from BlackRock in this, is it a biennial, every 2 years talk. So we've got 20 minutes. We're going to have a quick round robin of a few key topics and topical issues going on. And first of all, I think I'd just like to start off, Evy. You know, nearly 30 years in the industry now, and we've been through a few cycles. This is seems to be a very deep cycle. Perhaps just give us an idea of where you see things at the moment. I mean, commodity prices are pretty much stationary from where they were last year, off the top, but nevertheless, on an average basis, pretty stationary. China reopening has perhaps been a little bit disappointing, but at the same time, metal stocks are extremely tight, generally speaking. So perhaps have a look into the future with regards to 2024 on commodity prices. Where does the sector sit? And maybe also correlate that a little bit back to your experience over the last 30 years, and maybe any reflections on how other cycles can teach us the future.
Yeah, thank you, Jamie, and thank you for the event to have us here again. I mean, I think those last couple of presentations were absolutely excellent. Where are we in the cycle? What's happening in the cycle? How does it compare to previous ones? I think there's quite a lot to say in that regard. I think the first thing to say is that the cycle that we are going into, partway through, not sure exactly where we are, but I think it's going to be quite a long one, seems to have a greater level of resilience and breadth to it than prior ones. If you think about the China-related cycle of the early 2000s, it was very much that. It was a cycle that was born out of a long period of underinvestment, and then we had a demand event that completely surprised people in terms of its scale and, I guess, ferocity. We saw enormous increases in consumption over a very, very short period of time. And this happened at a time when the rest of the world was not really growing very much at all. So the cycle was pretty much completely dependent upon that kind of one part of the engine, admittedly a very large part of it. Where we are now is we're in what looks to be a kind of energy transition related cycle, again partly born out of a long period of underinvestment in capacity. And you saw the presentation from Mark where he showed you the reduced frequency of discovery rates. I think you could add to those slides by talking about the scale of underinvestment into production capacity as well. And then also some of the challenges around building things, whether it's the scarcity, the scale of investment required, the ESG challenges attached to development. So the supply side looks as constrained, maybe more constrained than in previous times. What we think on the demand side is that the breadth of consumption attached to the energy transition is going to make this cycle much more resilient and stronger, because we're not just relying on one part of the global economy to deliver that demand growth that we see. So if anything, we think this is going to probably be a more exciting, more buoyant, and one that's going to be filled with an enormous range of opportunities.
And do you feel as though, it feels to me as though this is a kind of 2000, 2002 era, if we just bring in the commodity situation with regards to where China was evolving at that time, and yet the valuations, the lack of finance generally for the wider part of the market, do you feel as though we're perhaps in that, well, it's easy to say lull before the storm, but do you feel as though we're in that period where there's a lack quite of recognition within the equities themselves?
Yeah, I think it was alluded to in the prior presentation. I think Mark made the comments around valuations, and when you go through those low points in the pricing cycle, you end up with an even greater discount to values. You know, what we're seeing today in our view is that valuations today are trading substantially below the replacement cost. And you can see that just from recent developments. You know, one of the world's largest new copper mines was recently completed, and the capital cost of that mine was far in excess of original plans. You know, the capital intensity per unit of production, you know, set a pretty much a new high for anything of that scale. And when you start to build those into calculations and then kind of back calculate the commodity prices that are required to justify those investments, you end up with an output that leads to a much higher commodity price deck to make those investment decisions for all stakeholders, whether it's for local countries, the taxes that need to be paid, employment, the infrastructure investments attached, and returns, obviously, on the capital that's gone into that risk. So, I think in today's environment, it looks to us as though existing producing capacity is trading at a massive discount relative to the replacement cost.
So I guess from that point of view, with regards to incentivization of new mines, we're not there despite these current prices.
Yeah, I'd say in some commodities, obviously, we've seen some very exciting price moves in the recent past that has triggered investment into new capacity. Some of those moves have kind of quietened down a bit and actually retraced in terms of some of the kind of the losses that have taken place more recently. Lithium is a good example of that. But price instability has a great, both positive and negative, a great way of encouraging or discouraging investment into capacity. So if anything, the weakness we've seen in lithium is probably going to cool people's enthusiasm for building new capacity at a time when the demand outlook, over the medium to long term, looks much stronger than the capacity that's being added.
So recently, BlackRock published a piece of research along with BHP we called Brown to Green. It all talked about the decarbonisation of the metals industry, and there were 2 or 3 particularly interesting points I just want to touch on that. One of them was, to me, the double whammy opportunity with which this sector has. The potential demand increase, which I think we've talked about and we've listened to earlier this morning, but also the valuation opportunity with which the sector enjoys or potentially enjoys from going through this process and the commitment that it has to decarbonising.
Yeah, I think the thing that we've discovered over the last few years is how mainstream it is now becoming for companies to be investing in decarbonisation related initiatives. I think initially some of those moves were seen as necessary, and didn't necessarily have the returns that you would hope that people would get from those investments. I think what we're now seeing is that the economic rationale of decarbonisation related investment is actually getting to not quite level playing field, but the returns are increasing quite sharply, and therefore it's becoming more competitive when thinking about investing into growth in production. And that is really encouraging when we think about the need for the industry to decarbonise, to be able to meet its own commitments around reducing emissions and moving through 2030 and to net zero 2050. These are huge initiatives. And why are they so important? Well, the world needs a lot of new supply to be able to meet the needs of the energy transition. If we continue to produce commodities in the same way that we have always done so, then we're not going to be solving the emissions that are going to be generated from increased production that's required to meet the increased demand. So we need to see a drop in emissions intensity, and then we need to see also at the same time a drop in absolute emissions to be able to move towards the goals that have been outlined by the companies. So we're really encouraged by the initiatives that the companies themselves are making. We're even more encouraged to see the dollars being spent, the infrastructure being put in place, and I think as time goes on, hopefully a greater amount of the world, specifically in the financial side, start to recognize this. And I think if the progress is met, then access to green capital at lower cost should accelerate that journey, but also should have an impact on valuations.
I'm glad you mentioned that. I'm moderating a panel on Thursday about green capital coming into the industry, so that wasn't a plug, but do come and listen to it. But that, I think you highlighted a couple of points here which I think are important. So within that piece of research, it highlighted in copper, and we were talking 2030, 2050 targets. In order for us to meet the 2050 targets, I think the 1.5 degree scenario, the amount of capex required for copper by 2030 to keep us on track is $250 billion. The amount of money to date committed is $50 billion. Where's that money going to come from? Where are those projects going to come from in order to meet those numbers?
Yeah, I think it's less about the money and more about the geology, as you saw in the prior presentation. I think there is a real geological challenge that the world faces with regards to being able to grow production enough to be able to meet some of those estimates that you outline. I think the money is potentially there. You've heard from ministers before this You've seen some of the plans around the US IRA, European Green Deal, and a lot of the other initiatives around the world. But I think in order to be able to trigger that investment, we need to be able to sit down and review how projects can be developed. How can communities accommodate the development? How should communities, host countries and things be rewarded as a result of that? And what other investments can happen in those countries to be able to allow those economies to continue to develop and grow and be a benefit not just of the financial return, but also the associated economic growth that can happen in country rather than just having the commodities exported themselves. So I think it's more about the geology. I think we need to do more exploration. We need to find more efficient ways of doing exploration so that we don't have that kind of hit and miss scenario. We have a higher probability of success. We also have to be realistic around the risk tolerance. A lot of the geology that is so prospective, where some of these potential new sources of supply can come from, are in riskier countries than maybe some companies have been used to operating. And so that needs to be reflected as well in terms of the plans. And I'd say lastly, one of the other ways of solving this is to be more efficient in what we already have above the ground. Can we think in a more circular way with regards to reusing things? Can we design goods and services in a way that they don't have to be redundant at the end of their life? Can they go back into circulation? So we can just replace parts and continue to have the majority of the kind of carbon that's been invested in building something not have to be respent or regenerated when we go and get a new good to replace what we have today. So I think there are solutions. It's not just about supply, it's also about demand and how we adjust consumption.
I listened to a great panel last night all about the circular economy and how metals are going, and clearly it's back-end weighted towards that 2050 thing, but it looks as though a huge amount of advance going on in that. I just want to come back to the finance point. You mentioned the IRA, the funds, the European funds, and other funds in the European government, the UK government adding to that last week. Money follows money. The valuations are roughly 50% lower than where they were in the 1990s. How can we get the equity capital to come in? I think the debt or the quasi-debt angle is there as discussed. How can we get the equity capital in? And is sustainability a key element of that?
Yeah, absolutely. I mean, I think when it comes to sustainability, I think we've moved into an environment which is very heavily data-driven and has been kind of wrapped around the acronym of ESG. But looking back in time, thinking about sustainability was always thinking about risk. As has been said previously, you have to understand the risks of going into any operation. If you lose your social license to operate, then it's catastrophic for the overall valuation of the investments that you've made. So understanding those risks, managing those risks, and trying to make sure that you've managed them through the life of an asset and beyond, so that there isn't a kind of a dead stop date. There's a positive legacy that exists as a result of the initial activity. All of that needs to be taken into consideration on the journey of making an investment. And I think that that's always been the way that we've tried to look at things. It's helped us at many points in the past. It's now it wrapped up in today's ESG lexicon and the backward-looking data that most people subscribe for. I think what we need to do as an industry is to break away from looking backwards, and we need to start increasingly looking forwards. We need to back businesses that are getting better. And that might be a painful thing to do today, because it might mean investing in businesses that haven't got the best track record. But if those businesses have a robust plan that's technically possible, well-financed, and you can believe that the management team are going to deliver on that through time, then surely it's better to be able to back a business that's going to be making a positive difference to the world in doing things better and helping an overall improvement than just investing in the businesses that are already good, that aren't going to make that incremental difference to the world. And I think that's the thing that we need to. We need to break away from this kind of backward-looking approach that we're so addicted to.
And I guess that, to some extent, I think the world of ESG sustainability has evolved so much over the last 2 years. And I think we're almost creating, and I think Mark alluded to this in his previous presentation, of a compliance side and a beyond compliance side. And I don't think anyone goes and buys Goldman Sachs or for whatever it is on the market, or for instance BlackRock for being SEC regulated. They go on there for the management qualities, the business qualities, etc. So the mining industry can learn from that. It's coming from an almost a very low base from a valuation point of view. It has so much upside if you go back to previous history. How can we go beyond compliance to raise that confidence and trust within these companies in order to bring in this new money to come into the mining sector? Well, it's a reputational risk, I think, issue, which a lot of these new funds are perhaps concerned about.
I think there's lots of ways. I think the first thing is to work with companies. It's understanding what they're doing, engagement, understanding those risks, going out and visiting assets, seeing what's actually happening on the ground. That kind of relationship that you build up with a company allows you to have a greater insight into everything you're taking on when making that investment decision. And that's what we try to do. We try not to be just stuck at a desk looking at a tear sheet from some external provider. I think if you did that, then you would have a much narrower investment universe, thinking outside of the box, seeing what things might have been missed by others, looking for areas of improvement, trends that you can back. Now, these are all really, really important parts of our process that we use in making those investment decisions.
So, and is sustainability the key to this valuation potential change?
At the end of the day, capital will move to where it can get the best return. Yeah. And there is a kind of fiduciary responsibility for investors to do that. But in that return obviously has to come with a kind of risk analysis, and I think the sustainability element comes into that risk analysis. And mixing those two things is complicated. But capital will go where it's going to get that return within those risk confinements attached to sustainability. When we look forward into the future, what are we likely to see that's going to trigger a change in valuation, which is effectively, I think, what you're asking. I think one of the things is we need to solve this kind of approach of being backward-looking and move to a more forward-looking, backing businesses that are improving, trading at a big discount today relative to their full potential. Cost of capital is a factor in there, and I think that that will solve itself as cost of capital declines if businesses do a better job. Right now, there are very high discount rates based on high costs of capital for the resources industry. I think if we start to get access to green capital because these businesses are getting cleaner and reducing emissions and so on, that will feed into the discount rates and so on, and you'll probably see a trigger. We've seen a very, very similar journey happen in the utility space, where you've seen utilities move away from a fossil fuel heavy a business model and move to one of renewables. Their valuation multiples have expanded rapidly as they've got exposure to that green capital. Maybe the mining industry should look at that and see what might be possible.
I mean, that to some extent brings me on to leadership within the industry. And from my point of view, I see an opportunity for a lot of these mid-cap and these junior companies to embrace this new world of sustainability and effectively provide or give confidence of these mines of the future, which have got to be either through M&A or through financing, develop and provide the metals into the supply chain which have the confidence, which can effectively deliver premiums. Is that realistic? Are the premium situation, are we seeing any evidence of that? I mean, Olivia Markham, your colleague, spoke recently that cost of capital is coming down, which rather surprised me at the time, but perhaps give a little bit of understanding of where we can see in the future on that.
Yeah. That's a big topic altogether in one. I think we are seeing evidence of a lower cost of capital. Money is being provided, whether it's through government schemes or whether it's through relationships with customers, and that capital is coming at a lower cost, or people are paying premiums for access to certain things, whether it's offtake and so on. So there is more money available, and it appears to be happening at a lower cost for companies. I'd say that's the first thing. I think the business model of producing something in a lower emission way is nascent. We are seeing premiums being paid for certain commodities that are produced with low emissions or even close to net zero. And if you think about the value chain, if the end customer wants to have the lowest emission unit of whatever it is, whether it's the construction of a house or a car or so on, they need to think about the decarbonisation of the supply chain, not just the fossil fuels that are used in how that thing operates. And if you think about a combustion engine vehicle, around 60% of the emissions from a combustion engine vehicle come from burning of the fossil fuels over its life. If you eliminate those fossil fuels and you replace that with electricity, then you take a big chunk out of that. If you then remove the traditional fossil fuel power and move to renewable power, then you eliminate that big chunk of the emissions. but you're still left with the 40% from the manufacturing process. And that can only be solved by decarbonisation of the supply chain. And if you can solve that and you can get access to those materials, then your proposition to your end customer is one of a truly zero carbon outcome, or very, very close to a zero carbon outcome. If that can be achieved, then what is the value of that in terms of growing your market share? What price are people prepared to pay for that unit? And if we can start to see that being priced in, either through carrot or stick, regulation, taxes, or through a society demanding it and wanting it, then I think that will trigger that change in the supply chain. We are seeing early evidence of that. It is relatively niche right now because the volumes are incredibly small. But what we're seeing is more and more investment to grow volumes of decarbonised materials production. And I think that brown to green transition we find very, very exciting.
Yeah, I was on this panel last night, and an interesting comment by somebody was there saying the brand value with which you can create by providing a commodity that has been certified, endorsed, or whatever it happens to be sustainable, can enter to then get the priority treatment by the OEM or whatever as a constant supplier to that OEM or any other consumer of the product is potentially something that more companies should be looking at.
Yeah, we need to see more volume.
Yep.
So we need to see more production that meets that customer requirement. And I think as that happens, we'll have better price discovery.
Yep.
And with that price discovery, we'll work out what the true value is in the hands of the different owners through that value chain. And if the end customer can end up affording it, or it's subsidized, or it's incentivized, or there's a taxation related, carbon border adjustment taxes, and so on. If all of that can be priced in at the end of the day, then that value should accrue upstream. And I think that the people who move first are going to capture the greatest slice of the reward.
Thank you for that. We're basically running out of time. Is there one question from the audience that would be hands up? Clearly, I've asked all the topical questions of the day. I think on that basis then, Evy, thank you very much for today. I think in summarising, clearly a demand increase is coming, and we're already beginning to see that. Sustainability is a central part to the new investment, but also the valuation theme. And from a brown to green point of view, in terms of decarbonisation and through this piece of research you've done with BHP recently, there's clearly value add in many different parts of this supply chain of the mining sector and beyond into the consumer part. So from that point of view, thank you very much indeed. Look forward to it, and thank you to all of the audience and to Resourcing Tomorrow for hosting us.
Thank you very much. Thank you.